What's up, traders? In today's video, I will be showing you how to manage your risk effectively when trading smart money concepts. So stay tuned. Now, at the end of the video, I will be showing you my exact risk management strategy and how I manage my risk when trading smart money concepts. But as always, we're going to dive in just a little bit of theory to give you guys an explanation of what exactly risk management is, why it's important, and how it can help us elevate to that next level in our trading. All right. So what exactly is risk management? What exactly is a risk management strategy? Well, risk management refers to the amount of capital you put at risk on each trade. Okay. It is usually calculated as a percentage of your overall trading account. And there are a bunch of free tools available online to help you with this. One position size calculator that I highly recommend is the myfxbook.com position size calculator. It's very simple to use. Essentially what this does is it helps you calculate the amount of lots or the position size that you need to open in order to risk a certain amount of your account. So let's just say, for example, I have a 10,000 US dollar account and I want to risk 1%. My stop loss is 20 pips. Once you hit calculate, it shows you that in order to risk $100, right, which is 1% of 10,000, you need to open 0.5 lots on your trade. Now, the general rule of thumb when it comes to risk management is that you want to be risking between 1 and 2% per trade, all right? And I will dive into why this is the case, but generally speaking, you want to be risking between 1 to 2%, all right? Now, a risk management strategy is necessary to help avoid blowing your account, right? So the name of the game is this. You want to keep as much skin in the game for as long as possible, okay? So let's just say you have $1,000 available to you to trade with. It wouldn't make sense to risk 50% of that $1,000 on a single trade, okay? Because if you were to lose on one trade, half of your account is gone. So what a risk management strategy allows us to do is it allows us to keep skin in the game for as long as possible. Now, what exactly do I mean by this? All right, let's look at a quick example. Again, we're looking at a $10,000 trading account. If you were to risk 0.5 on each trade, you would be risking $50 per trade. And what that means is you would need to lose 200 trades in a row in order to blow your account. All right, I'll say that again. At 0.5 risk per trade, right, you essentially need to lose 200 trades in a row before you blow your account. Now, if you are risking 1% on each trade, right, that would mean that you would need to lose 100 trades in a row before you blew your account. So as you can see, by doubling our risk, we have essentially reduced the number of trades that we are able to lose in a row before blowing our account. Obviously, if you were to risk 2% per trade, okay, you are obviously now risking $200 per trade. And now you would only have 50 chances before you blew your account, right? So notice how the more you risk per trade, the smaller the allowable losing streak becomes, right? So at 0.5%, your allowable losing streak is 200 trades. At 1%, your allowable losing streak is 100 trades. At 2%, your allowable losing streak only becomes 50 trades. Now, we also need to be very realistic here, okay? The chances of you losing 200 trades in a row, while they are not that high, it is a possibility. So, if you're trading a $10,000 account, surely you would want 200 chances to make money before blowing your account, as opposed to only 50 chances to make money before blowing your account. Okay. The only trade-off here is if you're only risking 0.5%, your profit potential is significantly lower than if you were to risk 1% or 2%, purely because there isn't as much money at stake, there isn't as much money at risk, so you wouldn't be making as much money. Okay. Now, the best way to offset this is by having a good risk to reward ratio on each trade. Now, there are a couple of advanced concepts that you can apply to your risk management strategy. Okay. One of them is having a maximum daily risk or a maximum daily drawdown. If you have taken a funding challenge before, you'd be very familiar with this particular concept. Essentially, what it means is that for every trading day, you are telling yourself that you are only risking 5% of your trading account as a total for that day. So irrespective of the number of trades that you take in that particular trading day, as soon as you have lost 5% of your trading account, you are done for the day. Then you no longer look for any trades, all right? This is just another strategy. It's another approach, another way of managing your risk, another way of protecting your capital, right? Something else that you could do is you could look at having a maximum number of trades that you take per day, per week, or per month. So let's just say you are a trader that in the past has over traded a lot. You've maybe taken 20, 30 trades per day, 20, 30 trades per week, and you want to bring that number down because you have been losing too much money. By incorporating a maximum number of trades per day, per week, or per month, you are essentially forcing yourself to only pick the trades, the trading setups that have a higher probability, right? And by doing this, you are also protecting your capital overall, okay? A third concept that you can look at, which isn't necessarily an advanced concept per se, but is to look at having a minimum risk to reward ratio before taking a trade. So me, for example, I like looking at and taking trades that have a minimum 1 to 5 risk reward ratio. Look, when you're trading smart money concepts, having high risk reward ratios is something that you can do, right? Gone are the days of trading 1 to 2, 1 to 3 risk reward ratios. You can be profitable, don't get me wrong, but with the approach to trading that we have, you can afford to look for trades that are 1 to 5, 1 to 10, all right, 1 to 8. And once you have a minimum risk reward ratio that you're looking to be satisfied, not only are you increasing your chances of being profitable over time, but you're also eliminating those trades that may be slightly lower probability, all right? A final advanced concept that you could also look at is something called a dynamic risk based on your trade probability. Now, this is something that I do as well. And in order to explain it, I will be showing you my charts in a few. But essentially, what dynamic risk based on probability means is it means that you adjust the amount of risk that you put on a trade based on the probability of that trade playing out. Okay? So what exactly do I mean by that? Well, here we have our simplified smart money concept set up once again. As you can see on this particular markup, we have a bullish trend. Okay? In this particular markup, we took a buy trade in here, and you can see that that buy trade was aiming for the weak high in here. All right. So how I use a dynamic risk management strategy is once price action breaks structure to the upside here and forms a new high, I can anticipate that price action is going to pull down. Okay. In order for me to get involved in the underlying trend, which is bullish, I want to wait for price action to pull back towards discounted pricing, okay? And then once it pulls back into discounted pricing, I want to wait for it to mitigate a valid demand zone before entering a trade, all right? So once price comes into my premium pricing, okay, and mitigates a valid high probability zone, I am going to be pro trend on that particular setup. And here I will look to risk 1% of my account. Okay. So when I am trading pro trend, when I am trading in line with the underlying trend, okay, I will risk 1% of my trading account. Now remember, as price action pulls back from this weak high, okay, there will be trading opportunities that set up on your lower time frames within premium pricing, okay? But because we are bullish here overall, it is not advisable to be looking for buying opportunities in premium pricing. We want to wait for price to pull back towards discounted pricing before we look to buy. But these trading opportunities that form in here, okay, especially if they are short opportunities, those are regarded as counter trend setups. And those counter trend setups, if I look to take them, I will only risk 0.5% of my account. Now, the reason I only risk 0.5% of my account is because I am essentially, right, when I'm trading counter trend, I am essentially trading against the underlying trend here. And that means that at any point in time, even within premium pricing, at any point, price action can mitigate something and continue with the underlying trend. So when I am trading counter trend, I want to reduce my risk to 0.5%, okay? Purely because there is a chance that that particular trade might not play out because I'm trading against all of that volume. So let me now give you a real world example, a trade that I actually took recently here on GBP USD. We're going to start off on the 4-hour chart. We can quite clearly see that price action is bearish in here, all right? So this is going to be essentially just the inverse of what we've just showed on the markup, on the simplified SMC setup. So as you can see, we have our bearish break of structure in here, and we have this bearish 4-hour leg in here, okay? We have our strong high up here. We have our weak low down here. In order for us to trade alongside the underlying trend, we want to wait for price action to pull back towards premium pricing of that 4-hour leg. We want to see a mitigation of a valid supply zone before price action continues down lower, all right? Now, notice how though, after price action, if I zoom in a little bit more, after price action puts in this low, we have that bullish pullback, okay? Now, during that bullish pullback, we can look for buying opportunities as price action pulls back towards premium pricing. Now, those buying opportunities that we look for are what we regard as counter trend setups. They are counter trend setups because essentially we are buying, right? If we look to buy in here, we are buying against all of this bearish volume. And there is every chance that price action, even while it is still trading within discounted pricing of this 4-hour leg, right? There's every chance that price action could mitigate something and continue with the underlying trend purely because of the amount of volume that is pushing price action bearish, okay? So any buys in here would be regarded as counter trend setups. Now, the way I treat counter trend setups is I only look to trade a counter trend setup if it forms within discounted pricing, okay? That's the only time I will look to trade a counter trend setup. As soon as price action crosses my equilibrium and starts trading into premium pricing, I will no longer be looking for counter trend buys. I will only be waiting for price action to mitigate a valid supply zone and continue with that underlying trend. The reason I do this is because, as I said previously, once price action grabs premium pricing, once price action reaches that equilibrium, at any point, my underlying bearish trend can continue. So I do not want to put my money at risk when there is such a high chance that price will continue down. But for as long as price action is trading within discounted pricing, I am more than happy to take counter trends. counter trend setups. However, those counter trend setups that I take, I will only risk 0.5%. Now, the reason I'm only risking 0.5% is because with a counter trend setup, you never really know, you never truly know what your trade potential is, right? Purely because at any point in time, price action can mitigate something and continue with the underlying trend, okay? If you're trading pro trend, for example, and if you mitigate something in here, for example, price action has now mitigated this 4-hour supply zone. If you take a trade in here, realistically, based on our approach to trading, you want to aim for this week low, okay? You have a clearly defined target that you can aim for when trading out of premium pricing, when trading alongside your underlying trend. However, when trading from a counter trend point of view, you can only look to trade towards the next S&D level, because at any point in time, a mitigation can occur and price could reverse, right? So in this particular scenario, after price action, right? After price action began with this bullish pullback, I identified this 4-hour demand zone, and I knew that there would be a potential opportunity for a counter trend setup in here. Now, don't get me wrong, all right? Identifying this as a 4-hour demand zone is a little bit more advanced. It definitely isn't something as obvious as this 4-hour demand zone, where you have a bullish engulfing candle, where you have a break of structure, and where you have your imbalance, all right? This is just something that the more you trade SMC, the better you'll get at identifying zones like this, right? But be that as it may, if we now drop down to the 1-hour chart, and if we just zoom back a little bit here, take price back a little bit, what we can see is within that larger 4-hour zone that sits something like this, we have this 1-hour demand zone that forms in here, okay? We have a valid break of structure. We have the imbalance as well, okay? So we have this valid 1-hour demand zone that forms. So once price action broke structure to the upside here, I was looking to trade this 1-hour demand zone as a counter trend setup. So we break structure to the upside, price action pulls back, it kind of creates these equal lows, which we know is liquidity, okay? Once it creates those equal lows, we can see the price action around about just before the open of the New York session. We have price action push up, we grab this liquidity, and then we tap into that 1-hour demand zone, right? So what I was looking for is to trade the open of that 1-hour demand zone, and I was only looking to trade this thing until the next level that would kind of make sense, all right? Now, because I only look for a minimum 1-to-5 risk reward ratio, there were 2 areas that stood out for me for potential targets, right? Actually 3. The first one was this previous high in here, okay? The second one was this 1-hour supply zone in here. And then the third one was this liquidity that sat in here, because you can see that this liquidity was not taken yet. So when it came to deciding which target I was taking, my first target in here only gave me a minimum 1 to 2.6. And I wasn't necessarily happy with placing my targets there. So I looked for my next target. You can see that my next target was a 1.35. Again, not quite what I was looking for, but notice how this particular 1-hour supply zone, right, sat at the equilibrium of my overall 4-hour leg. So this is a scenario where, depending on what market conditions are, right, I would stray away from looking for a minimum 1 to 5%, a minimum 1 to 5 risk reward ratio, and I would comfortably put my targets here at a minimum 1 to 3.5, purely because I know there's a lot of bearish volume in the market. This sits at the equilibrium, and there is a chance that price action could mitigate this and continue lower. So this is where I placed my take profit, was this 1 hour supply zone which sat at equilibrium. Okay, so you can see that price action taps in, price action pushes up. All right, this is the point where I move my stops to break even, and then price action continues. We smash our take profit target, and then price action continues even higher. So you can see that we have just a small reaction from this 1 hour supply zone. Okay, but price action continues up, and it now has mitigated. It has now mitigated this 4 hour supply zone in here that sits within premium pricing, and you can see that we've had that sell-off. So how you would now approach something like this, and how I'm approaching it, is I did not take a trade at this 4 hour supply. I am waiting for price action because I have now seen the mitigation of that 4 hour supply, and I've seen price action push down. I am actually waiting to take a sell in this 4 hour supply in here, okay, which we can see is a valid one. Again, if I go out to the 4 hour, we can see that it is a valid 4 hour supply in here. Why? Because we have an engulfing candle, we have a break of structure, and we have just a little bit of imbalance in there. So we have mitigated something in premium pricing of that overall 4 hour bearish leg. Okay, we have kind of confirmed that we are now bearish again with this break of structure. And what I want to do now is I want to wait for price action to pull back before continuing. Obviously, price action might just from this point push up higher. Why? Because it is now interacting with this 4 hour demand zone in here. So there is a chance that price action, right, from here continues bullish, probably mitigate something a bit deeper before continuing, or from here just continue pushing up higher, right? There's every chance. But the way I like to approach the markets is I like to trade alongside the underlying trend, and the underlying trend right now is a bearish market. So that was just a very quick way in which I use a dynamic risk management strategy to adjust my risk based on the probability of a trade. Quick recap, what I like to do is whenever I am trading a counter trend setup, I only risk 0.5% of my account. So in this case, when I am looking to buy against all of this bearish volume, I am only risking 0.5%. And then as soon as I am pro trend, as soon as I am taking any pro trend trades, then I risk 1% of my trading account. Okay, I do look for a minimum 1 to 5 risk reward ratio. However, in this particular scenario, as you saw, right, I was comfortable taking a 1 to 3.5 risk reward ratio purely because we had a 1 hour supply zone that sat at the equilibrium. And because of the fact that I am trading counter trend, I did not want to be too greedy, right? So I was more than happy to just take a 1 to 3.5 risk reward ratio on a counter trend move, right? And there you guys have it. If you guys enjoyed this video, please make sure that you hit that like button, subscribe to the channel so you don't miss out on any future videos. I appreciate you guys so much for watching, and I'll see you in the next one.